Good morning, everybody. I'm Dan Smith, President and CEO of the Vermont Community Foundation. I hope everybody had a lovely weekend. We've got folks piping in from near and far. It was a wonderful snow weekend up here. I hope people got outside and enjoyed it. Before I dive into the presentation, just a couple of quick observations. Some big things happened this weekend, including Tom Brady winning his 10th Super Bowl. I turned 46, which is also apparently officially the age when you pick your head up at the Super Bowl halftime show and ask, who is this? So trying to open the webinar with a little bit of humor out of the gate. I can't tell if anybody's laughing or not, but I'm just going to assume you are. Thanks. I'm really excited to help co-host and convene this Invest in Vermont series. As President and CEO of the Vermont Community Foundation, we're excited for the week's worth of presentation. There's some great stuff coming up. I want to acknowledge and thank the steering committee for pulling this together also. Let me advance my slide here. Out of the gates. Give me 1 second. Start that right over. Thanks, guys. Again, I want to acknowledge and thank the steering committee who helped us pull together a really wonderful set of programs this week. These are all wonderful partners, deeply committed to making a difference in Vermont through the tools of investing in communities, thinking differently about ownership structures, fostering entrepreneurship, and really leading in place with their vision for what Vermont can look like economically and in the sphere of entrepreneurship across the state. Some really wonderful and creative partners reflected in this week is, I think, an indication of the energy and creativity in the entrepreneurial space in Vermont right now. So I think it's important to acknowledge that, this is a remarkable turnout. We'll see if people drop off a little bit because they stayed up late watching the Super Bowl, although there wasn't much of a reason to. But there were nearly 300 registrants. This is one of the biggest events focusing on entrepreneurship and investment in place that many of us can recall in Vermont. So very excited that there's this much energy around investing and raising capital and pursuing the difference we want to see in the world through creative entrepreneurship in this place. So in a moment, here's what's on tap for the week. I do want to call out these events and the breakout sessions through the course of this week. Local investing later today at 5 p.m. Tomorrow, closing a capital round in Vermont, behind the scenes look. Wednesday, investing in Vermont using place-based ownership to keep our money local. Thursday, after the pitch, aligning investors and entrepreneurs. Friday, local investments, tangible results. Community revitalization with downtown real estate development. And also Friday, addressing the unconscious bias in the investment world and the important investing in women-owned businesses, BIPOC-owned business, and non-traditional entrepreneurs. So really an incredible slate of top-shelf thinkers who are coming together around these themes and these topics to better serve the investor community, the entrepreneurial community, and the community development network that exists in our wonderful, wonderful state. Before I hand it off to Karn Cross, really to dive into the broader investment context, the thing that I'm going to ask participants to do as you're engaging throughout this week is really, keep in mind a few framing questions and think and poke and prod and ask each other and ask panelists to address these and offer your own reflections. We've been through in the last 12 months, a number of major disruptions, the pandemic, the civic and social disruptions associated with it, a crisis in terms of our access to information that borderlines on, frankly, a public health issue. The question is, what is the investment context in Vermont? How has the landscape in Vermont changed? How has the landscape changed nationally? And how has it changed in the last 11 months? How are these disruptions playing out in terms of what people are looking for the entrepreneurial sector to deliver, and and how are investors thinking about where capital can both make a difference and make a dollar? So, and what's different in ways that inform how capital will show up for Vermont entrepreneurs? But first, before I turn it over to Karen Cross, I do want to address a question that may be out there. Why is a community foundation hosting a platform of, interested investors and entrepreneurs? I need to answer that question. I need to address a little bit about who we are and what we do. The Vermont Community Foundation since 1986 has been helping funders find and fund the causes they love in the places they care about. We're the Vermont's largest grant maker. We're home to more than 800 charitable funds and manage more than 370 million in assets. And in 2020, in this pandemic year, we gave out approximately 4,200 grants totaling more than $31 million. About 20 years ago, our board adopted a rule that said no less than 5% of our assets had to be invested in Vermont to advance our mission. At the close of 2019, we had about $13.5 million in Vermont mission investments actively at work in Vermont communities. That's part of a key piece of our theory of change around the opportunity gap, making sure that Vermonters of every background have access to economic security and opportunity in their place. We lean on the opportunity gap, focusing on early care and learning, support for youth and families, college and career training, and community and economic vitality. And really that last quadrant, that last piece, community and economic vitality, is where our mission investing shows up. We can build a strong youth and generational development pipeline, but if people are walking down the street in their community and don't feel like there's a sense of potential or a sense of opportunity, you're going to end up with a generation that is disengaged, frustrated, or leaving the state in pursuit of opportunities that exist somewhere else. So we view, and in many cases, the kinds of challenges that philanthropy is asked to address are downstream of the underlying economic circumstances that exist in Vermont. When the pandemic hit in March, I think Vermont collectively and many of us in the social sector came to the realization that it seemed like we were going to have the public health aspect of the crisis well in hand, but the pandemic was landing on a second set of communities that were economically more vulnerable than we had really come to grips with previously. And so the question for us, as we marshaled the incredible generosity of the philanthropic sector in the last 10 and 11 months, partnered with the non-governmental and the nonprofit sector, the question was how do we address the near-term emergent needs in response to the pandemic, while also beginning to think about some of the systems at play that help Vermont aspire to be more resilient in the future. Vermont families to be more resilient, Vermont communities to be more resilient. And we see as a key piece of that, marshaling the entrepreneurial energy that exists in the place and standing up that energy and supporting that energy. So out of the nearly $10 million that Vermont philanthropists gave into the COVID response fund in this past year, one of the longer term economic resilience strategies that we seeded was focused on entrepreneurship and rural development. So in addition to prior grants into rural incubators and regional incubators like the Space on Main in Bradford, Black River Innovation Campus, the Lightning Jar in Bennington, through the COVID response fund, we've put another probably $800,000 worth of grant making into the entrepreneurial ecosystem in Vermont, supporting VSET's startup collective, additional support for regional incubators and accelerators, really hoping to seed, the small business creation and the entrepreneurial energy that will help lift Vermont communities out of this recession, out of this downturn, out of this disruption, and set the table for a much more resilient set of communities in the future. So We see this, the opportunity for investors to be thinking about how their capital go to work in Vermont communities. We see it as a key piece of that long-term resilience and that long-term recovery. So that's why a community foundation helps convene an event like this with such wonderful partners as those identified at the outset. Place-based mission investing is part of a three-pronged approach for us in terms of our community impact. We're looking to put capital into Vermont projects and companies that keep local economies vital. We engage in community, we provide grants, and those place-based mission investments help drive that aggregated impact, that integrated capital impact in Vermont communities. Our strategy for mission investment, again, comes from a 20-year board policy that says a big piece of our assets, meaningful piece of our assets, have to be invested in Vermont to advance our mission. More recently, since I started, we've put a premium on this strategy, focusing on downtown revitalization and the creation of good paying jobs and supporting local entrepreneurs across sectors. We're really interested in the way businesses engage in place and the communities and the communities around them. We invest alongside trusted co-investors and through intermediaries, everybody from Fresh Tracks, the Flex Cap Fund, to Vermont Housing and Finance Agency, Vermont Land Trust, a number of partners on that as intermediaries for this place-based mission investment pool. These are just examples of some of our partners that we've made both direct investments in and some of the intermediaries we invest in, partnered with Community Capital of Vermont. The Putnam Block in Bennington, a great example of a downtown revitalization project. The inspiring piece for us as a philanthropy is realizing that it's not necessarily the dollar amount, but the way the capital shows up in a complex, public and privately financed project. The ability of our ability to take on a somewhat different risk than other either lenders or investors helps unlock, in some cases, and leverage a substantial amount of public and private investment, and helps get projects closer to those finish line. And it's all about generating momentum in communities, really changing the perspective and sense of potential people have in place. So you'll see High Mowing Seeds here, the largest employer in 4 small towns at the gateway of the Northeast Kingdom, working fields and employment services agencies for people in recovery and coming out of incarceration at a time when workforce has long been identified as one of the biggest barriers to the growth of our business sector. Figuring out how to support people who've dealt with challenges in their lives and get them back on their feet and get them back in the workforce is both a strong community impact, but also a potential economic driver. So wonderful partners here: Encore Renewable, Sun Common, Ceres Greens, located in Barrie. So you'll see the kinds and types of investments we're looking for and the wonderful partners that we have in place. So a quick observation about where we're going and where we're going next. I'm really excited to sort of listen to the conversations through the course of this week. We continue to believe that this is a growth area for us. The foundation's been set. A growth area in terms of the impact that capital can have in communities and that philanthropy can have in communities by virtue of bringing more of our managed assets to bear on the trajectory of those communities. When you show up in Springfield and you see your grant making that supported youth after school programming, that supported the accelerator program, and then you've had mission investments that helped the Springfield Co-op relocate to the downtown core, and you've seen affordable housing redevelopment in that same place. You begin to get the alchemy of momentum changing investment that is occurring in Vermont communities. And the investor set and the entrepreneurial set are folks reflected on this call are going to be key to the recovery that we want to trigger. We collectively as Vermonters want to trigger and inspire coming out of this pandemic experience. So a few quick observations. I think we're going to be leaning and learning more, hoping to learn more about alternative ownership structures, employee ownership how we can connect ownership to place, how we can help seed the connection of growing businesses and their impact through strong employment, strong and fair employment practices to place. We're also keen to surface non-traditional entrepreneurs, supporting women and BIPOC-owned businesses, making sure that access to capital isn't predetermined by either network, race, family background, or region. There are wonderful ideas parked in every corner of this state that can have the potential to help change the trajectory of communities in terms of their economic underpinnings. And I think that's a key piece of our strategy as we think about our trajectory going forward. Again, just a moment, I'm going to hand it over to Karen Cross. I do have, again, just a couple of parting thoughts to help frame, hopefully, and these are my quick observations on the landscape of capital in Vermont and the way it's showing up to make a difference in the landscape of investment. Karen's going to get into the details a little more directly, but these three or four concepts I think are going to help, begin to define the way capital shows up for entrepreneurs and what investors are beginning to be looking for. There's very clear, and this is well documented, very clear interest on the part of investors in understanding the non-financial impacts of an investment. People are turning to capital markets and direct investments to pursue the difference making that they hope to see in the world. And we see this as an incredibly potent lever, either in alignment with the broad objectives of the Community Foundation. We see this as a potent lever for the creation of strong, economically vital communities. And there's also abundant and clear recognition that we're all collectively less successful, and businesses are less successful, the economy is less successful, and our communities are worse off if people's access to funding for good ideas is limited to race, gender, is limited by race, gender, family background, or lack of access to the network of capital providers and investors in this state. I think we're also in the middle, by virtue of the pandemic and by virtue of the experiences and by virtue of our ability to pivot onto technology in ways that a year ago would have seemed sudden and abrupt. I think we're in the middle of a flip from an ethos that said density and concentration geographically produce strength and alchemy and efficiency, in favor of a realization that spreading out and staying distributed is more resilient, and that distribution and that disaggregation and that space, both for capital and for people, can be more resilient and healthier in the long run. And that has implications for not only for how and where people live, but it has implications, I think, for how capital will flow to ideas and projects and purposes in different places. And last, I think we're in the middle of a realization, because of some of the civic dynamics that have emerged in this country, there's increasing recognition that rural communities, when certain pieces of infrastructure are present, are frequently undervalued, and that they can offer a remarkable platform both for making a difference in this country and in Vermont, with investments, for making a difference with investments that rebuild those communities and economies. But they also offer an incredible platform for actually making a reasonable return over time for patient, community-minded investors. So before I'm about to hand it over to Karen Cross for some of the details about the landscape nationally and in Vermont. I want to just acknowledge this incredible alchemy that I think is emerging right now, that people collectively recognizing that entrepreneurship, new business creation, and energy are key to the kind of resilience that we aspire to in the state of Vermont, across regions and across communities. And then we as investors and as community-minded actors really have a role to play, seeding that kind of growth, seeding that kind of community evolution, and seeding that kind of shared purpose that I think will make the greatest difference over time, and that we can help change the course of these communities and for our neighbors for the better. undoubtedly, there are more lessons for Vermont communities ahead, and there's some incredible discussions lying ahead of us this week. And so again, I ask you to listen and engage, share your thoughts, share your reactions. And as you're listening and engaging, let's keep in mind, these are the kinds of times that put every orthodoxy, every rule into question. And so we have the potential to rethink the role of invested capital in the trajectory of employment, the trajectory of business startup, the trajectory of Vermont communities in some really inspiring and really exciting ways in the coming years. And if we do that well, Vermonters and Vermont communities will be more resilient for the long term. So just take away the understanding that your investments in Vermont entrepreneurs, Vermont projects make Vermont more resilient. And they're also part of a potentially very sound diversification strategy that makes all of us collectively stronger and more resilient. So I'm going to stop sharing my screen. I am going to turn it back over to Karn Cross, or turn it over to Karn Cross. We'll once he's done his presentation, we'll dive into a little bit of a Q&A, and then look forward to hearing your questions and addressing them then. But thank you for taking the time. Thank you for participating this morning and coming together in what is, again, one of the largest summits of investors that those of us who've been watching these things for a little while can recall. So thank you very much.
Thanks, Dan. I am going to share my screen here. And Dan, if you could give me a thumbs up, or somebody give me a thumbs up to make sure that my screen is up and running, that would be that'd be great.
Yes, we can see it.
Great, thank you. So I'm Karn Cross. I'm the co-founder and managing director of Fresh Tracks Capital. I'm excited to be here. This is going to be a great week with some terrific presenters, and what I want to do here is give you an overview of the early stage entrepreneurial ecosystem as it relates to finance. And first, just a bit of a commercial interruption here. Fresh Tracks was formed in 2000. We're investing now out of a fifth fund. These are discrete funds with a usually 10 to 12-year life cycle. We've completed investments in about 55 companies, and about 3/4 of our investments are located in Vermont. I have some logos up here from some of those Vermont investments companies that you, in some cases, may recognize, other cases may not. Four things that I'm going to talk about this morning. I'm going to give you an overview of what happened last year in the US venture capital markets. I'm going to then bring that down to Vermont and talk about what happened in Vermont in the early stage investment markets. I want to try to pick out what I think are some interesting trends happening in the ecosystem, and then I'm going to also try to give you some post COVID thoughts for Vermont. This is going to be a bit of a data heavy presentation, at least at the beginning, and with a bit of context. And you might ask, where does all this data come from? For 2010 through 2019, the data comes from a private information company called PitchBook in association with the National Venture Capital Association. And then in 2020, because that data isn't complete yet, what you're getting is first half of the year, that data supplemented by my own research. And really what I do to try to figure this out is look at the SEC website and look for so-called Reg D and Reg CF for crowdfunding. filings with the SEC, and that is public information that tells me what companies in Vermont have raised money. I want to note that these data sources are imperfect, and in particular, you can use, you don't have to use Reg D or Reg CF to raise money as a private company, not to get all geeky or wonky in the weeds here on things, but you can use, I think it's a 4B3 method of doing this, and therefore that's a kind of a stealth mode. And I know there are some companies in Vermont that raise money that that use that method, and that data does not show up here anywhere. So here's the last 10 years in the national venture capital market. And in the teal colored bars here, that is the total value of all the investments that were made in that year. And that is in billions. That is in billions of dollars. And then the deal count, the number of actual investments that were made, is in this kind of rust-colored line. And you can see that, you know, the number of investments made nationally in venture capital went from, you know, essentially doubled in these 11 years, but the value of those investments soared by about 5 times. So these are big markets. And you notice 2020 was, in terms of dollars invested, the one of the biggest markets that we've seen ever in you know, from a national statistic point of view. This is a different way of looking at the data, and so PitchBook and the NVCA break this down into 3 buckets. They have what's called angel investments and seed investments. That's the blue part of this pie chart. Those are smaller investments. Those are generally in pre-seed and seed stage companies, meaning they probably don't have much revenue. They may be a bit of a science project. They're not very far along. They probably don't have product market fit and things like that. The red section here are early stage venture, and what that means is typically what's called Series A and Series B kinds of financings, preferred stock financings. Generally, those early stage ventures do have some product market fit. They've got some real revenue. They're probably entering some sort of a growth phase. And then in green is later stage venture capital, and this is much more mature startups. It's typically, in some cases, pre-IPO or in lieu of IPO. And, you know, this isn't quite an 80-20 chart here. It's a, you know, 70-something, 30-something chart, but the no surprise, the later stage investments are where the bulk of the capital goes, even though they're the smallest number of investments. And then the largest number of investments, the angel and seed stage investments, get the smallest share of the capital. And when you break that down by average investment size, the seed and early stage, angel and seed stage investments are a couple $1 million on average. The early stage Series A, B stuff is on $12 million on average. And late stage investment on average, each one of those investments is typically a $30 million investment. I want to particularly point out female founded companies. And you'll notice that the value of these deals has gone, you know, up in the right direction. In general, the number of deals has gone up. It slipped back a bit in terms of number in 2020. So 2020, about 2,400 out of those 12,000 deals were female founded. And by the way these statistics are kept, it means that there's at least one female founder as part of the founding team. And then the other thing that I want to mention at the national level is this incredible kind of out of nowhere burst of the use of special purpose acquisition companies, or SPACs, which are basically a clean shell public company organized with a blank check to go usually purchase a control position within an emerging company, or in many cases, this is even moving down into the earlier stage investment world. And we're beginning to see SPACs used as part of a venture capital firm strategy. So this is a very unusual occurrence. To some extent, I think it has to do with the fact that so many companies are delaying going public, or have delayed going public in the last decade. And kind of the open question for me is this a bubble, or does this have staying power, and will this disrupt the early stage capital markets? So here's kind of my thoughts on all this, and I'm a little cynical. So the first bullet point here is COVID. What COVID? I mean, those markets that you just saw don't seem they seem very disconnected from the reality being experienced by many people and communities across the country. Forgetting about that for a minute, 5 times increase in dollars over that 11 years, a 2 times increase in the number of investments. This means that the skewing of this is slightly larger deals. And then the fifth bullet point here, venture capital has typically been very place-based and concentrated in certain communities and areas. And the general rule of thumb when we founded Fresh Tracks 20 years ago was that most venture capital was invested within about a 1 hour or 2 hour drive from the headquarters of the venture capital firm. And over the years, that's changed a bit, but really in the last couple of years, and in particular this year, things have changed relatively dramatically. And it used to be that you did not make an investment unless you had spent time with the company founders and management, and you toured the facilities, and you'd gotten to know them over a period of time. And therefore you didn't really conduct your diligence to make your investment decision in any way but face-to-face primarily. And that has changed this year. There are a lot of anecdotal examples of fairly large firms doing a complete digital diligence process and literally writing large checks without having ever sat down physically across the table or visited a company headquarters or things like that. That I think bodes well for Vermont over time. And then there is an increase here, a pretty strong increase in female founder fundings. I think we would all agree that there's a lot more progress to be made here. So now let's bring this down to Vermont at this point. So I'm going to show you similar data here, although it's not exactly the same, and I'll try to explain the difference. So the bar chart on your left is the number of investments, same time period as the national piece. And in general, you see an upward movement, and to the right, where we go from 11 recorded deals in 2010 up to 31 recorded deals in 2020. If I showed you the previous 10 years of data, you would have seen deals in 2000 around 5 deals a year. And so that essentially progressed upwards during the 00 decade. And then over on the right in green, there's a bar chart that's really, and by the way, these are millions of dollars. Those other charts I showed you were billions of dollars. And there's a bit of noise in the dollar per year data. And this is, you know, kind of Vermont's law of small numbers, where if you have a few good size fundings, you skew that data a lot for that year. And therefore there's some noise. I'll show you a chart in a minute that attempts to eliminate that noise. Why was 2010 the high watermark for dollar investing, and yet there were only 11 deals? Well, some notable companies raised money during that time period. Seventh Generation was one of those. FabTech was acquired, or majority interest of FabTech was acquired. Dealer.com did a good size fundraising. There were a number of things that happened in 2010 that made that kind of an outlier. And one thing that I find interesting is that in 2020, we invested in 9 of those 31 investments, or we were part of making 9 of those 31 investments. That's about 30% of the overall market. And if you go back to the 00s, if you go back to that previous decade, we were typically between 50 and 90% of the market. And from my perspective, what you're seeing here in this chart is a really good thing for the ecosystem, because what it's showing, and we'll talk a little more in a minute about this, but it's showing a maturity and a growth in the ecosystem and the number of investors, which is positive overall. Here's the chart where I try to eliminate some of that noise. And so what I've done here is taken a 3-year rolling average of the dollars for each year, and then drawn a dotted trend line through here. And basically what you see here is that as the number of investments go up, no surprise, the average dollar size of the investments has come down. And so if you look at the last half of the teens and the more recent couple of years, the average deal size in Vermont has kind of settled into this low 7-figure range, kind of $1 million to $3 million range, kind of average investments that are being raised. So here's a pie chart, and this is similar but a little bit different than the way the national folks break it out. We don't have a lot of true later stage investments in Vermont. We have occasional ones. So the way I've broken this down is a little different. The blue is less than $1 million financings. The red is $1 million to $10 million financings, and the green is financings of more than $10 million. And so in 2020, there were 3 investments of more than $10 million, but those 3 investments produced roughly 65% of the $100+ million that was invested in 2020. And then the rest of the investments were split pretty easily or pretty evenly between sub 1 million and 1 to 10 million investments. What I find interesting, although not surprising, is that when you look at these 31 investments, 20 of them were equity investments, 11 were debt investments, for the most part convertible debt investments, meaning they can convert into equity. And when you look at the 14 deals less than $1 million, the vast majority of those were convertible debt. So if you are an entrepreneur investing or looking for investment in Vermont, you're raising a round of less than $1 million. Convertible debt is probably an instrument that would work for you. And then one investment that we'll talk about in a minute used the the crowdfunding Reg CF, which is somewhat unusual. Here's another way to look at this data and to think about these three buckets. So less than $1 million round size, typically those companies have about 2 investors on average. So it's a small round. Typically, the average check size for those investors is a little over $100,000. So think of these as like $250,000, $250,000 to $300,000 rounds of capital with a small handful of investors to complete that round. When you're trying to raise $1 million to $10 million, that's a different ball game. That generally takes a little more than 10 investors in concert to raise the money you need. And the average size of these investments is, let's say, a little under $250,000. So from an investor point of view, if you're going to be investing in deals above $1 million, be prepared to write checks in that $250,000 range. And then when you get to the larger deals, there's more, no surprise, there's more investors needed and larger check size. By the way, the small number of 10 million and up, the 3 deals, skews this that $10 million and up information somewhat. If I'm breaking these down by industry, what does it look like? A lot of investing in med tech and health and wellness. Quite a bit in the consumer space and food and beverage space. Some emerging deal flow in marketing technology or MarTech. I'll talk about that a little more in detail. Adult beverage, no surprise, we punch above our weight in the cider, beer, wine, spirits category. Insurance technology, aerospace. I'm going to talk about aerospace in a little bit. We are an ag state. Dan mentioned high mowing seeds as a Vermont Community Foundation investment, and that's certainly one of these 2 deals. Energy, media, and other just means they don't fall easily into one of these buckets. So what is all this? When I look at that data, what do I think? Well, here's how we stack up from a female founder funding perspective. Roughly 7 out of the 31 companies had at least one female founder, about 22%. Those companies raised about $17 million. That's pretty similar to the national average. So as you know, I said earlier, long way to go here, but these numbers are significant. I'll talk a little bit more about core map in a couple of slides. I mentioned there was a regulation CF funding, crowd-funded equity deal. This is Shaftesbury Cider, one of the adult beverage companies. Why do I find this interesting? Well, the most money you can raise in a Reg CF offering is slightly under $1.1 million. You can raise $1,070,000 legally. And in order to do a crowdfunding raise, you use a platform, and Shaftesbury used Startup Engine, and they raised the maximum amount possible from 400 discrete investors nationwide, most of whom they had never met before. This is, to my knowledge, the biggest and most kind of significant Reg CF funding that anyone's done in Vermont. And if I was an entrepreneur thinking about using crowdfunding, I would beat a path down to Shaftesbury, virtually, of course, and talk to Colin and David and find out just how they did this, because I think this is a really interesting development. Here are a couple of things that are examples of Reg D deals, which one of them being Dealer Policy, an insurance technology company. This is a screenshot of an announcement on LinkedIn from a few weeks ago announcing their $30 million Series B funding. This is a rapidly growing company in a really interesting industry, and bears watching in the future. And then CoreMap, which represents a company with a female co-founder. This is a screenshot of their announcement last year of completing a $10.5 million Series A funding. So the other thing about CoreMap is it's really a spin out and commercialization of some technology developed by researchers at UVM. And this is a medical technology company working on some new therapies and technology that can be used in atrial. Here's where I'm way out of my element. Atrial fibrillation, the problem that many people have with their hearts, which is a tricky thing to diagnose and manage. So interesting example here, and one of a couple last year of things coming out of UVM and then obtaining significant funding. And then this one is an example of a SPAC, and this happens to be a 2019 investment, not a 2020 investment. But because SPACs have become so popular, I want to point out that one was used in Vermont. Jensen Acquisition Corporation, which was a blank check, clean slate public shell, purchased Peck Electric, which was a roughly 35-year-old company that had pivoted and really established itself as a large EPC or engineering procurement construction contractor in the solar and the commercial solar space. That company has grown since acquisition here. It has a high market cap at this point, or an interesting market cap. And then early this year, Peck bought a company called iSun, which is a Vermont company, a much smaller company, but they changed their trading symbol, their ticker symbol, to iSun, and they're trading under that. So kind of a fascinating thing that I think has been underreported in Vermont. And then these are two industries that I think are interesting emerging industries and clusters in Vermont. One of them is marketing technology. I've put some logos up here, but by my estimation, there's about two dozen companies that have started in the last, let's say, 5 years that are part of this MarTech ecosystem. Marketing technology is one of these very hot areas overall nationally, and is an industry that has been buoyed and lifted via COVID. I'm sure you've all bought more things online last year than you might have in any previous years. And if so, you were like the vast majority of Americans. And so, great cluster. And this cluster really comes out of, really has its roots in the diaspora of dealer.com. And so when dealer.com was built over a period of a couple of decades in Vermont, it produced some great talent. Some of that talent has left, and some of that talent has gone on to form and or work for this emerging cluster. So really, from an economic development perspective, something that I think is interesting, and also something I think is not necessarily recognized, and more attention should get paid to it. And then the other cluster that I find interesting is aerospace. We've always had some aerospace industry in Vermont, going way, way back decades. It's typically been companies serving, the more airplane-oriented market. What we have here is really, again, some examples, but Benchmark is a vertical takeoff and landing, is a small sat propulsion system. So Benchmark is a small sat propulsion system playing in an interesting space, and also UVM technology spin out. GPMS serves the helicopter market in monitoring rotors and so forth. Beta is vertical takeoff and landing electric vehicle. And then liquid measurement systems kind of rounds out this piece of it. So there are some interesting things happening in aerospace. We've got some talent in these spaces. I told you that I think the reason we have more investments in Vermont is because we have more investors. This is a list of some of what I would consider to be the investment syndicates. These are not necessarily in any particular order or ranking. One of the syndicates that does a lot of investing is really JH Capital, which is comprised of the Crook family. Jim was a former CEO of IDX, and this syndicate also includes a lot of ex-IDXers. Hula, which is a more recent upstart syndicate, is a group of folks associated with the Hula real estate project on the waterfront, the old repurposing of the Blodgett building to serve some of the entrepreneurial economy. I think many of you are probably familiar with that. BT Innovation Fund is a construct of the purchase by Shores Communication of Burlington Telecom. So there is a investment pool that invests particularly in Burlington, in city located companies. The Community Foundation, as Dan mentioned, the Vermont Seed Capital Fund, which has been around for roughly a decade, that operates in conjunction with the Vermont Center for Emerging Technology. The Vermont Sustainable Jobs Fund's Flex Capital Fund, which is a revenue-based, royalty-based debt. They also do a bit of equity player. They've been around for a decade, and then Fresh Tracks, obviously. So here's some post-COVID thoughts. These are mine. They may be highly incorrect, but here's kind of the way I look at it. I think it's more important to have a lot of financings than for the overall dollar amount to be high. So I pay a lot more attention to how many financings are happening every year. And I like the increase in numbers that I see. I think that's better overall to have a decentralized amount of funding in a lot of companies. If you think of Vermont startups as a portfolio overall, portfolio theory would say, make a lot of investments, make a lot of bets. Even though these numbers, like, $100 million of funding in Vermont in total, it's a lot of money for Vermont. These are still pretty small numbers overall. I often say we're the flea on the back of an elephant, with the elephant being the national venture capital markets. And because of that, our data, particularly on dollars, can be really skewed by one or two discrete financings. Third bullet point here, multiple entry points to this market. I just had a slide up of all the different active investment syndicates, and there are emerging syndicates that I am aware of that aren't on that list right now, that will be on this list in the future. I think this is really good. This is the sign of a healthy, maturing, early stage market, even though we are a small market. The other thing I would mention is a lot of Vermont companies are taking advantage of this virtual world and becoming part of national and international acceleration programs. So they're applying to and getting accepted into large programs, Y Combinator, things like that. A recent example is a company called Sassable, which is in our portfolio, which has been accepted to the AICPA, the American Institute of CPAs, Financial Technologies Accelerating Program. This is a great opportunity for Vermont companies to get noticed immediately on a national level, and theoretically to get funding from outside of Vermont. There is a real inflow, of capital in Vermont. You typically don't do $10 million and greater financings without having some of the money come from outside the state. And that's increasingly true in the $1 to $5 million range. So there are plenty of firms who will come to Vermont, and particularly these days virtually, and make these investments and round out these syndicates. I think that's a good thing. And then at the same time, the pandemic is enabling companies to employ workers virtually. I think this, if I'm a policymaker or an economic development specialist, this is both good and bad, because it certainly allows Vermont companies to say, hey, the talent pool I'm now recruiting from is nationwide, and I don't have to have a conversation as to why they should move to Vermont or not. I'm going to allow them to work remotely. The good part of that is, hey, I'm a Vermonter, and there's nothing for me to do in Vermont because I'm highly skilled in some area that we don't have, a lot of clusters of talent in. Oh, no problem. I can work remotely and not have to leave the state. So this is both good and bad. And then, there are anecdotally, and certainly I've talked to a number of these folks, there are a lot of COVID refugees in Vermont, here for some period of time. And, as the vaccine takes hold, as things happen, some of these folks are beginning to emerge and assimilate into this ecosystem. I think that overall is a net plus. This last slide here is just a shameless promotion. Another firm, information firm called CB Insights collects this data every year, and they make a map of the largest investors, the most active investors within each state. And then they put the logos up there. We have, I think, for about 4 or 5 years been that largest investor. There's going to be a time, I'm sure, when we're not. I don't think that's a bad thing. I'm a competitive person, but I don't think that's a bad thing for Vermont if we're not here at some point. I want to point out one thing that I'll leave you with as we move into Q&A. If for some reason your eye was drawn down here to Mississippi, you'll notice there's no logo. And that's because they don't have enough active investors to meet the minimum threshold for CB Insights. About 5 or 6 years ago, when CB Insights first started keeping track of this and putting this map together, there were a lot more white spots across the country. And today there's really only Mississippi. And I know sometimes up here we tend to pick on Mississippi or pick on the Deep South. But, honestly, the rebirth of rural areas and small markets across the country investment is important in that rebirth. And so I'm certainly glad that when you look here in New England, you see a lot of great active investors that play a role in their economy, and we're certainly proud from a Fresh Tracks perspective to do that. So I think we got a bunch of questions here, and I think Sarah is going to moderate this. And
I am. Thanks, Karen.
okay.
All right, so we have about 14 or 15 open questions, and I've been leaving them open so that I can aggregate them a bit. So Karen, I'm going to do a couple for you first. I'm going to try to combine them because they're related to your slides. There are 3 in particular I'm going to try to put together into one big multi-part question. We had a question about the business types that were emerging as opposed to historical business types. And in particular, folks are interested in that emerging slide that you had with aerospace and marketing tech, cannabis, gaming, virtual reality, artificial reality. Folks were wondering about those as well. So maybe you could start by telling us about any of the other emerging industries that are on the horizon.
Yeah, so I picked a couple, and it's hard. It's always hard to pick from these. The reason I chose the 2 that I did was there was enough examples of investing activity happening And with marketing technology, also a lot of examples there of like 2 companies on that slide I know have plans to hire in each of them an additional 25 people this year. So there's some real, I suspect that there will be several hundred jobs added in marketing technology, in the next, let's say, 18 months. So that's an area I can point to. In some of the other areas that were mentioned, I think cannabis still suffers really from the overall, like, what's the regulations and how do they work? And, how does Vermont's regulation or, lack of it fit into, New England and the Northeast and so forth. Investment in cannabis has been volatile nationwide in the last number of years, way up, way down, way back up, and so forth. It's tended to be concentrated in larger states where there's an active recreational market, at least from what I can tell. A lot of activity there. So, I'm not convinced yet that there's a lot of predictability to that piece of it. I think the other, gaming, augmented reality, I'm sure somebody would mention crypto and blockchain and those kinds of things. Again, I'm not seeing enough of that rise to the level, but I think it's like right below the surface. And I can imagine in a year or two, my slide would look different.
That's great. I'm going to try to combine a few more here because a lot of folks had questions about the data in your slides. Private equity and angel funding, are they following the same trends as venture capital in the growth and industry investment?
So I'm going to break those down. Angel investing is included in the in those NVCA PitchBook data. That is inclusive. It's also inclusive in what in the Vermont data. So we lump that together. Private equity is really something, in my opinion, I think the industry would say also different. Private equity is typically control position financings. It can include turnaround. It can include buyout. It can include things like that. That is not included. There is separate data on that. I've not chosen to include that. And that is also, those are a small number of deals in Vermont, a lot of bouncing around. You have a buyout. It's a big deal that year, and then you have nothing for a year. So
I'm going to try to tackle 2 of the questions that have come in most recently that are sort of bigger picture and about the ecosystem that exists around some of these investments. One question from Paul Kendall is about the multiplier effect, good jobs, wages, other goods and services that are an impact of businesses in Vermont being invested in. And then another question that came right on the heels of that one was maybe about the role of innovation and universities in the ecosystem in Vermont, and what role they might play in the growth of our innovation economy. So maybe you guys could try to tackle some of those ecosystem related questions.
Yeah, Dan, I'm conscious that I'm answering all these questions, and you on these bigger picture things, you may want to start on this one.
I'd be happy to, I'd be happy to dive in. I think, frankly, from our perspective as a place-based mission investment, an organization pursuing place-based mission investments, Paul's questions about the quality of jobs and the impact of that sort of level of economic stability in place are pretty key factors for us to think about. We know that the experience across Vermont communities coming out of the 2008-2009 recession was very disparate in terms of the pace of recovery, and in some places not recovering the level of economic activity for up to a decade after that downturn. And so we think about that lens very directly in terms of a lot of our direct investment decision making. And I think it's important, I think it's important and hopefully appropriate for the investor base in Vermont to be thinking about as a whole. Where there are plenty of folks out there looking for a good return. But there's also just, the very real factor that I think a lot of these communities and a lot of these opportunities are missed or undervalued because of where they're located geographically, and the opportunity to make a difference by making a placement in such a community is pretty remarkable and pretty meaningful. Now, our goal in philanthropy, there are plenty of independent foundations that exist in Vermont. This idea of aligned but independent strategy, people grant making alongside each other, people making investments alongside each other. All of this capital shows up in community in an integrated way and helps change the trajectory of those communities. So I think to Paul's question, I think those are really important. They're important factors for us to decision and hopefully to consider in making our decisions, and hopefully for more folks. Remind me the second piece of that.
Yeah, universities and the innovation ecosystem.
Undoubtedly, I think you can look at the University of Vermont's commercialization, and the work that has come out and spun out of research at UVM, and there's been a number of different companies that have emerged out of that. I think many of us caught the news of biotech's transaction a year ago. That was my recollection is that biotech was founded by Mr. Alpert was a faculty member, a researcher at UVM in terms of spinning that out. I hope I have that right. But there's an incredible amount of activity related to the university. I mean, Champlain College obviously is in an integrated way around gaming and technology, has played a pivotal role in creating this ecosystem, Middlebury's footprint, and indeed Vermont State College is the connection of Northern Vermont University to the Due North co-working space in Lyndonville. I think those kind of, thank you, those kind of community integrations and community intersections between higher education and place are key to the creative volatility that generates good ideas that are worthy of funding. And again, sorry, I blanked on the name, but Dr. Norman Alpert was the founder of biotech and coming out of UVM. So I mean, there's a legacy of that intersection, and I would say Vermont is uniquely situated. Higher education in Vermont is on the ropes, in terms of some of the systemic challenges in higher education, but that doesn't mean that the community impact related to that volatility and the creation of those ideas and the intersection isn't present. Hopefully the institutions work their way through the challenges they're facing, but the economic dynamics that are driving new business creation and the knowledge-based economy and MarTech and those kinds of places, those are pretty healthy and strong still, and important to recognize.
Okay, I'm going to try to come. Oh, sorry, go ahead.
Yeah, I don't have much to add there. I'll just, I will point out, because Dan mentioned kind of the geographical piece. When you look at those 31 investments, and I'm doing this from memory, but I think 27 or 28 of those are really within that Chittenden County area. And then you see much less venture and angel investing when you spread out. That's a problem. I mean, that exists. We, from policy making perspective, we can argue, like, how do you fix that, or can you fix that? But that certainly 2020 data it's concentrated in Chittenden County.
Well, it's interesting. I think some of the questions in the queue here are going to get to that a little bit. Let me see if I can combine two more. One was about the digital due diligence trend that you had mentioned nationally. And the first question is related to whether or not we think that might open access for more women-owned businesses, more businesses of color, and whether or not that might continue after the pandemic, that we see investment beyond that radius around the headquarters. But then there's sort of a second one here that I'm going to try to combine with smaller investments happening in the state of Vermont in particular, with a wider pool of investors. Without the traditional sort of getting to know you stage that you mentioned, do you have an idea of how, with what methods or metrics, investors are actually evaluating companies?
Yeah, let me let me take the first one first, and then you may have to remind me, Sarah, as I get to the second one. But I think this digital diligence thing is really interesting because, our whole firm was founded 20 years ago because we could see concentration of capital around Boston, around New York, around Atlanta, and so forth. And there wasn't really that much here. And part of the problem was we were geographically far away. So we decided to apply a very traditional model to place. And so therefore, for the last 20 years, and really I was part of another firm before this, which focused on Northern New England. And so my entire grounding in venture capital is very much this: get to know the teams over a long period of time, get introduced to this real traditional kind of way of doing things. So I feel super comfortable doing that. However, I'm not the future, obviously. I mean, given my age and so forth. What I'm finding interesting is talking to the younger partners at firms across the country who have a much broader lens and who have, maybe they're located in a non-traditional area, Detroit, Columbus, Ohio, Lexington, Kentucky, wherever it might be. But their outreach and their prospecting, because of the digital tools, are way broader. They're covering way broader geographies than something that we've done. So at least, from my perspective, how should we be doing this? What should we be doing? What I think is good for Vermont is not necessarily for us to broaden our focus to all of Northern New England because we can do it digitally. I mean, it might be best for us to do that. I don't know if that's best for Vermont. What I think is best for Vermont is there's a lot of other firms around New England who say, hey, I don't actually have to drive from Portland, Maine to here to look at a deal. I can do most of the stuff digitally. I can Zoom into board meetings and things that I need to do as part of my governance and so forth. So, okay, that might be real positive. Does this mean that this will be better for BIPOC businesses, better for women businesses? I think it has the potential, but I still think you tend to invest where you look and where things happen. And certainly if you look at state policymakers last year trying to get triple P money and EIDL money and grants and so forth, federal grants to, in particular, BIPOC businesses, also female-owned businesses. Certainly on the BIPOC side, there was a real struggle like, hey, okay, so where's the list of BIPOC businesses? Oh, there really isn't one. Uh-oh. And then, I know Curtis Reed down in Brattleboro did some, and his organization did some good work going out and assembling some of that information and then surveying. And those results have come back in the last month or so. And it's both interesting and disturbing read, because clearly there is a disconnect between the BIPOC business community and the non-BIPOC business community. That is going to ripple into investing. It's going to ripple into banking. It's going to ripple into all those things. That's a problem, right? And that problem, we've all collectively got to figure out. So I think it's a great question.
A good question.
Yeah.
So the second half of that was about whether or not you could speak to the kinds of metrics, especially given your experience, right? The long-term relationship building. What are the kinds of metrics or methods that investors are now using to evaluate companies?
There is a trend nationally toward analyzing data that's available, kind of publicly available on companies. So, I'll use PitchBook as an example. PitchBook has so much information now that if you subscribe to it, if you actually pay for the information service, you get incredible detail. And it's gotten to the point where there's a lot of firms that are prospecting for new investment by parsing and analyzing and building tools around PitchBook data and saying, okay, here's 50, like this year we're gonna target females of color in these areas working on these particular things. Okay, are there 50 or 100 companies like that when we parse through thousands of things? Okay, there they are. And now we're going to do outreach to those particular firms those particular companies, and begin a process of figuring out what we do. Most of those companies probably have built digital, data rooms where they have kind of all the materials you would need to do your initial screenings. And then, through Zoom and other tools, you can actually spend, a bunch of face time.
Quite a bit of time. Yeah. Yeah.
That's already happening. I don't see why that won't happen, more and more and more. And then the other thing is there's these things called demo days, and demo days were where acceleration programs would showcase their graduates. So acceleration programs have a cohort of 20 or 25 companies. They put them through a boot camp process and a bunch of other things, work with them for a couple of months, and then they would bring them all together in a room. They would bring a bunch of investors and others into a room, and you would get this real contact, and it was all organized around that. Well, there's no reason that can't be done virtually, and is being done virtually. And again, if you're a Vermont company and you're participating in a Y Combinator program that would have been in San Francisco, or a Techstars program that would have been in Boulder, and now you can do it from Vermont, and the virtual demo day brings in people from all over the world, that's a whole different, a whole different market. So I think it's hugely exciting, particularly for somebody who is 25 or 30 years younger than I am, where it'd be like, all right, my whole career is going to be different, right? Because of that. So,
yeah, great. I have a couple more about specific industries, but I want to ask these two again, kind of in combination, and see what you guys can do with them. One is about tax incentives. Let's see, is there any exploration of tax incentive for companies launched in Vermont, or for angel investments in certain sectors? And I'm going to combine that, so hold that one in your head for a moment. Arian also asked a question about the shape of the capital market and deal structures for companies that are never going to grow big and IPO, but rather are capturing smaller markets and staying in small towns as pillars of those towns. So a question about whether or not some kind of incentive, like tax incentives, or a specific sector for Vermont, companies launching in Vermont, and the other about size or scale and what that looks like.
you want me to go first on that, Dan?
I'd invite your perspective on the tax incentive question. I would say that, my experience and my understanding of the landscape of employment growth incentives is that it's pretty narrowly targeted towards, the expansion of payroll and employment in Vermont in terms of our program design for, economic development tax incentives. But my information about the angel tax credit, there used to be one, but it may be out of date, or at least my information may be out of date. I don't think that's currently in effect.
Yeah, we do not. We did have one years ago. It wasn't really used that much, which is why we don't have one. I'm kind of two minds on this to some extent. Maine, by the way, the state of Maine has a very active and well-used angel tax credit incentive. If I was a public policy maker, I would study what's happened there over the last 5 years, and I would talk to the folks involved in that ecosystem, and I would figure out whether that worked, because if it, essentially a lot of what happens in Maine, has some real similarity to Vermont. I will tell you one thing, though, that it's done is because of the structure of the way that works, the tax incentive is created, and then on, basically January 1st, it becomes open, and it's a capped amount. And so there's a land rush. If you looked at a chart of when deals are done in Maine, you see a big number that come out in that first quarter, because they're driven by pretty substantial credit. So it will skew behavior to some extent that you may or may not want. But Maine's the place to study. I would go there and I would study that. In terms of but that's an incentive for investing. In terms of all of the other programs, VEPSI and other things, sometimes venture-backed companies will use some of those programs to the extent they make sense. One of the problems, I think, if you're a venture investor is it takes time and effort for your management team to figure out the application, submit the application, understand the qualifications, monitor and do the reporting that they should do because they've received, some public benefit and so forth. And all of those things can be somewhat distracting. And so I know there certainly are a lot of investors in the marketplace that are kind of like, yeah, you don't really need, like, don't waste your time on that. That's maybe pejorative to say it that way, but like, we'd rather have you spending your time doing X or Y or Z than we would figuring this stuff out. That doesn't mean they don't play a role. It doesn't mean they're not a good thing. And then there was a second question in there around what I would call non-scale companies, because that's really what we're talking about here. Venture and angel investing typically goes into companies that have the ability to scale kind of far beyond just serving their local markets. They may be pillars of their community over time because they employ a lot of people, but they're not truly a local business. So that is, in fact, what we've been talking about is that kind of thing. When you kind of peel back, okay, how do you go about financing, a non-scale company in Vermont? This is kind of the geography a lot of the local banking community and credit unions and community loan funds and all of those kinds of things. And to some extent it still is, and here's where, all the bankers in the room are gonna like light up and start, screaming at me in a minute. But, the consolidation of banking in the state has changed that landscape. And you used to be able to get data, like a Vermont-owned bank would report to the Department of Financial Regulation, and you could actually look at loan outstandings and a bunch of other things. You had good data there. Now the number of those banks reporting in that fashion has shrunk, and everybody else is part of a national entity. You honestly have no idea as an outsider when you're trying to access information, like, okay, what is the small business lending look like in Vermont? It's a difficult thing. Anecdotally, bank consolidation doesn't necessarily lead to better small business lending. That's my personal opinion.
It wouldn't be a full panel with Karen Cross if he didn't say something moderately provocative. But I think to your point, though, the one thing I would push back on a little bit is I actually believe that Vermont is, relative to its size, very well served in the network of CDFIs, community development financial institutions, credit unions, and community lenders and community banks, the community loan fund. And so there's a pretty vital role that network plays in community and economic development, and most recently demonstrated by the ability of Vermont businesses to access PPP lending through those partners. And that was a pretty remarkable pivot and demonstration of service for a lot of folks in that space.
Yeah.
To Arjan's question, though, I do want to, I think this is it's an interesting one for the long term, whether it's growth trajectory or scalable company or a community, a community anchor institution that's offers employment, robust employment in a particular place. We are in a set of generational transitions, a generational transition of wealth, generational succession of ownership of a lot of closely held businesses that are anchors. And, I think there's going to be a window in the next few years for a robust exploration of what the local, ownership structures look like that allow, community capital to come to bear on the retention of that interest in place in some of those businesses. And whether it's employee ownership, whether it's a cooperative ownership, whether it's some other structures. And we've seen that come up in some of our conversations with, Vermont philanthropists who are tied to closely held businesses and elsewhere, just an interest in not wanting to part with their business and not wanting to put their business at risk of parting with place, and trying to figure out how to answer that question. I don't have the answer yet, but I think it is a pretty compelling one for a lot of folks on this call, probably to think about how to unpack as we go forward, because we do, there is a abundant, history of how good it is for communities, for ownership and employment, and those intersections to be held in place and by regions, and what that means for those communities.
So I wouldn't be doing my job as moderator if I didn't get a chance to say that there are a lot of great questions we're not going to get a chance to answer, because I think, Dan, you have a few slides left to go. Is that right?
Well, I think my slides mostly touch back on, what's coming up next, in terms of the next few, in terms of the 5 breakout sessions between now and the end of the week. I touched on the beginning. Go ahead.
Then let me see if I can do one more 60 seconds from each of you. Does that work?
Sure.
There's a really good question that I'm going to try to combine, and if you can both be quick. Beyond bringing capital to Vermont, what are some of the other key important factors that might be really vital for us? Folks have asked about 5G. They've asked about opportunity zones. They've asked about other things that might be important levers or factors for bringing investment to Vermont. So if you could both do 60 seconds, then I'll stop my job.
So levers to bring capital to Vermont, undoubtedly the future, the economic future of rural communities and, the entire state is in some level dependent on access, to high speed telecommunications, whatever form they take. The recent Rural Development Opportunity Fund auction, Starlink raised several $1 million out of that federal auction to support Vermont communities. So the question is, are we going to roll out fiber and wires on poles faster than Elon Musk is going to put satellites in the air? Is one that Vermont will have to reconcile with and then figure out what it means then for entrepreneurship and the economic vitality of rural communities. I think workforce and economic inequality and disparate experiences are going to be fundamental levers in terms of the long-term trajectory of businesses in this state. If people are having trouble finding people, I know that you can find people anywhere, but if the disparate experience that exists in state continues to advance the way it is and the way it has for the last 10 or 15 years in Vermont, I think we're going to be wrestling with both civic, social, and economic consequences. And there's some, I think, public policy issues that need to be addressed in that. I think the Opportunity Fund, the Opportunity Zone funds, are an interesting mechanism in terms of changing the landscape and potentially bringing motivated capital back to place. The real risk is that it become, I know on a national level, the real risk is the fear that it become, the most effective tool for high expense gentrification, in the history of public policy. But the reality is it could be an incredibly compelling tool for bringing money into communities, that the 25 communities that have invested in Vermont. What I haven't seen yet is a systemic approach to bring those resources to bear in Vermont with some credibility and the relationships in place to see that done effectively. And I'm going to throw out, sort of a final what's on the horizon for the VCF. We have roughly 300 donor advised funds at the Community Foundation. It's a big piece of what we do and how we support funders. We're right now actively exploring the launch of a donor advised fund that would be, and a charitable advised fund that would be fully invested in the Vermont pool, fully invested in Vermont, and also generate the grant making impacts that a lot of philanthropic minded folks want to see. So to be able to open a fund and that is invested in the communities you care about, that's generating grant making to complement it in the communities you care about, we hope is one more catalytic tool for the difference we want to see in Vermont communities. Thanks, Sarah. That wasn't 60 seconds, but sorry.
Does the fairness doctrine apply to me? Can I get 60 seconds?
We still have 110 people listening, so you guys.
Oh, well, here they all go. So I think everything Dan said was great. What I think would actually attract more capital to Vermont is more successful exits from Vermont companies producing more successful entrepreneurs, because success sort of breeds success. A lot of investors don't like to invest in first-time founders, and we have a lot of first-time founders. We're heavily skewed to first-time founders in Vermont. And so one way to unlock capital is to help those entrepreneurs become successful, to exit, and then presumably if they do it at the right stage in their life, they're serial entrepreneurs, they go back and do it again. And now it's easier for them, because they're, you know, a name brand with a track record, it's easier to attract outside capital in those situations. And it also, like from a give back perspective in the community, it works really well. You know, there's a lot of talk about, oh, you know, the companies, you know, when a founder makes money, they move to a low tax state, you know, because they can manage those episodic events of selling a company and be somewhere else. And, you know, you see a lot of different data parsed in different ways. You know, from my perspective, what I observe is, at a certain level, when founders can predict their exit and can manage around that, they will indeed manage for tax effect some sort of a geographical move. For them, it's really up to them. They don't all do it, right? There are plenty of people who have made lots of money selling their Vermont company, who have paid the taxes and stayed here. Here's my issue with the ones who leave, and that is that the ones who leave, for the most part, with a few exceptions, put down roots somewhere else. And even if they're snowbirds in coming back here, it's been hard for them to stay as connected and to mentor and help. Again, with few exceptions, there are some people that are doing this great. You know, they've gone somewhere else for tax reasons, and they're still spending a lot of time here. And this is still home for them in a lot of ways, and they're helping out in the ecosystem. I don't think we've ever really explored that issue. We've come at it in a lot of different ways, but we haven't actually said, what's the impact on the entrepreneurial ecosystem when people make their money here growing an entrepreneurial company and then leave for some reason having to do with, let's say, tax structure, right? And I'm not, you know, again, I'm not trying to make a judgment issue on this. I'm just saying we haven't really gathered all the data, and I think it's an important thing to do that. At the entrepreneurial founder by founder letter, there's all kinds of data that's parsed out based on income levels and assets, but it doesn't address this founder thing, which is where it's hugely important.
I think your first point was a really important one to end on, which is celebrate the wins, right? I mean, people need examples of success that carry them forward and keep capital motivated about the difference it can make and the return it can generate in a place like Vermont. So I'll just say thank you everybody for the time today. Thanks for participating. Plug in for the next 5 sessions. If you'd like to sign up for additional sessions, there is the link in the chat. It touches on everything from aligning investors and founders, downtown revitalization, implicit bias in investing. There's some just wonderful topics over the course of this week, and hopefully you get value out of these conversations and go forth and do wonderful things in Vermont communities. So, and thanks as always to Fresh Tracks and to Karn for their partnership. Thanks again to the other members of the steering committee and for pulling together a wonderful set of presentations and a wonderful set of discussions this week. I'm at Karen's emails in the chat. I'm at dsmith@vermontcf.org, dsmith@vermontcf.org if you want to reach out as well. And again, thanks for taking the time this morning and participating. Take care.